So, without further ado, Coach, which it's like the perennial value stock. Like since I started at the Fool in late 2013, it's always been like, wow, Coach is really cheap. What's going like perennial? Just beaten up. It's like it's a great brand. It's still earning money, even though it's a little bit less. Chinese growth, I'm sure, was talked about. But they finally showed some sales growth. So what's going on?
All right, so big picture context here. Coach has been struggling for the past couple of years now. Overall, I'd say it was a combination of too much promotional.
Just say
selling.
Michael Kors, Vince. Just say it.
Definitely more competition from the likes of Michael Kors or Kate Spade. You're absolutely right, but they got really big into doing these sales. I think it hurt their brand image a little bit.
It takes away the luster of it, for sure.
Exactly. So for this most recent quarter that they reported, their fiscal 2016 second quarter ended December 26th, so includes, pretty much the most important period in terms of the holiday shopping season. This was their first, I believe after 9 or 10, you said, quarters, where it was like declining year-over-year revenue. Finally, they were able to buck that trend. Break that that streak. So net sales were actually up 7% year over year in constant currency, 4% if you include the effects because they're international business, of course. And their adjusted earnings per share were about 68 cents, which down slightly year over year, but beat most Wall Street estimates. Overall, the company, like I said, is going through that transition where management right now is really focused on cutting their underperforming stores. They're reducing some of those.
So yet another
promotions.
retailer closing locations.
Exactly.
Wow.
They're improving their product quality, just trying to focus on longer term, like restoring that brand reputation. But that costs money. So as a result, during this quarter, we saw their SG&A expenses go up a little bit. They're also integrating their Stuart Weitzman acquisition, which they made early last year, I think.
Was that big?
About close to $600 million. So not huge.
That's bigger than I was expecting.
In terms of its contribution, they mentioned that, they've seen a lot. They're very, very encouraged by initial results from that segment. I think Boots, for example, did really well despite the warm weather, just in terms of the big trend right now. You see boots on a lot of people, and Stuart Weitzman's just a pretty small portion, about 7.5% of their top line. But like I said, management's very, very encouraged by the results that they've seen, and breaking down in terms of the geographic segments, which you'll see big differences. So where in one case, their North American stores continue to post losses, their comparable store sales are down 4%. But you mentioned China. Particularly mainland China did really well for them. I think sales were up double digits.
Beijing has the world's largest Coach store.
Oh, really?
Right? It is the world's largest Coach store. I saw it is in Beijing.
Oh, okay. See,
there's a reason for that.
I can't say I'm surprised. International sales overall for the company, revenue was up 9% year over year in constant currency. And then for mainland China, it was very strong, but there's some weakness still in Macau and Hong Kong.
I'm not surprised, but it's kind of wild that it's hitting Coach now because you obviously saw, Wynn and Las Vegas Sands kind of saying, yeah, things are going rough over there right now. So
I hadn't thought about that situation. When we've covered it previously, it's always been focused on the gaming side.
Right.
But
it affects the entertainment side. And
absolutely.
The deluxe.
And the shopping side, of course. Hong Kong's known, has some world-class shopping, and I'm sure that's not helping. But other than China, in terms of the international segment, Europe and Japan also saw pretty strong results, double-digit numbers in terms of improvements. So this company, their shares were up, I think last I checked about half an hour ago, up over 9% today on top of the positive momentum from these earnings. The stock fell about 13% in 2015, which kind of honestly mirrored a lot of other retailers, but it's down over 50% from its peaks in 2012. So obviously management is focused on that recovery process, and it's a good sign to see here, not only in terms of integrating that acquisition, but just overall their international business. I think management also mentioned that for North America, they're hoping to see comps turn positive by the end of this fiscal year. So definitely a nice change, and to see after 9-10 quarters of down revenue.
So you obviously read the press release, the stock. Do you buy it right now? Not the stock per se, but do you buy what management's saying? Does it make you somewhat bullish?
Yeah, I think that I have gone into a few stores, and obviously this is just my personal experience, but I feel like in terms of the styles, and the their offerings now, it's definitely going a little bit more in terms of like, their traditional, like, Coach traditionally was known for like really fine leather products, and I think for a period they had offerings that were like very heavily branded, started moving away from that because most fashion trends moved away from that, and now they're kind of restoring that customer traffic and sales. And I think what management's doing now is important. It's necessary.